This is Dime After Dime. This is your show. This is where you say, hey, Don, welcome for...
I'm not ready yet. Just because Pete over here is ready.
Takes you a little bit, huh?
We have to. We need to show them that you're not a rigid asshole.
Good luck.
That's going in the open. All right, folks. Welcome back to another episode of Dime After Dime. I'm your host, Tony Stich. I have the pleasure of interviewing Don Drury, president of Moran Wealth Management, about a very important topic, which is really the idea around when should I sell my business and why. So I want to set the landscape for the listeners and viewers here before we dive in. So when we think about you own a successful business, you're kind of looking at retirement. Folks are oftentimes thinking between a successful exit through a sale or through the transition of a business to someone else. What are the things that they should be considering early on as it relates to, again, a succession plan or a monetization?
Well, there's a lot to unpack there. I think one of the most important things, and something that most business owners do too late, is give thought to this. Successful business owners are focused, hyper-focused on running their business. And it's only at some point, and usually a point close to when they would ideally like to have the transaction, that they start to consider this or think about it. And often it's an inopportune time. It could be that we're in a bad economic cycle. It could be, I don't know who I could sell it to. I don't know if any of my underlings, part of my management team, I don't know if they're ready or financially capable of taking me out. And they haven't gone through what's a really important aspect, is improving the margins in your business, really focusing on those things that move the needle in terms of obtaining the highest price. So there's a lot to do, and often people wait too late.
Yeah, because like you said, they're working on the business,
Right?
not thinking about the future, and the future comes pretty fast in some cases. I actually met a business owner who was prepared, and I want to punctuate one of your points. If he was prepared, he was so ready that he recognized that I might have to drag forward the sale of my business based on economic cycles. And oftentimes they don't. And if they're not planning ahead, what happens is they might have to sell at a downturn,
Right.
which reduces the value of their business. So by being prepared long enough, what recommendations do you have around the timing around that?
So traditionally, we are big proponents of people giving thought to this 5 to 10 years out. So that gives you the opportunity to spend time with your executive team, really get to know who has the ability, the proclivity, someone that you could spend that time with, really honing their skills to successfully take over the business. Often, in something we haven't chatted about here, often it's a partnership. So it's the two of us, and we own a cigar lounge if it's the two of us. And the hope is, with most partnerships, I'm the older guy, so I'm out, you're going to buy me out. But the question is, will you have the funds to do it at that time? So for partnerships, out of the gate, it's having a great buy-sell agreement between one another. Perhaps one of us is hit by a bus. So there's an immediate need for liquidity for the other family. That's an opportunity. If we don't have the liquidity or the wherewithal to cover that, That's an opportunity where someone could obtain some very inexpensive insurance to ensure that there's a smooth and easy transaction.
What other successful kind of strategies should we think about as it relates to succession plan? That's a great one, right? Especially in the partnership model, starting it off right on the correct foot. But what are other successful strategies when you think about a succession plan?
Well, again, I'm going to reiterate because it's
Please.
important, starting early. One of the aspects, so I have a couple good friends that do M&A work and kind of the middle tier market. And one of the things that I hear from them consistently is businesses achieve higher multiples when operationally everything is defined and it is very clear that your business can operate without you. Because put yourself on the other side of the transaction. Do you want to buy a business that's dependent upon Tony and Don and what we do in it, and absent us, it might not be as successful? Or do you want to buy a business that is efficient, that has operational guidelines and very clear operation, COO or someone in that role? That's a firm that will command a much greater multiple.
Sure. And also, I think it's important to point out, I mean, we can discuss, means of financing, right? How
Sure.
can we finance that transaction? But also, I think the big one that you might have missed, I think you alluded to it, but it's the messaging too, right? If it's Don and Tom, or Don and Tony, or Pete and Broderick, whoever it is, right?
Right.
If one of them is the face of the business, it's how do you properly message and prepare the client base or the industry or the market for a potential exit? Because you don't want to lose that value of the business, right?
Sure. Well, and again, that gets to, if you're doing it at the 11th hour, it's difficult to do that. A lot of businesses don't spend enough time early on. Therefore, it's a hasty process, and that messaging doesn't go through. The successful ones do begin to message, and most importantly, they message once they have the plan. It could be our cigar lounge. My son, Tyler's graduating, wants to run a business. It could be that we begin to figure out how I exit and bring in the next generation. And then for me and for you, it's, do you want to be in business with Tyler? And I would argue he's probably a better partner than I am. But then for me, does Tyler have the ability, because he's my son, is he expecting a sweetheart deal? I need those proceeds to replicate the income that was coming to me. So with family, it's very interesting because it's different than an outright sale to a third party. It's different than an ESOP because often it's obviously not an arm's length transaction. Parents want to be fair to their kids. Their kids may not have the ability to do that. And then there's the internal question: have I accumulated enough assets for the lifestyle I'm accustomed to based on the income I was receiving as a business owner?
I love that. Actually, that leads me into the next question. Really, there are a few monetization paths, right? There is
Sure.
the family succession, there is the management buyout, and then there's just the third-party sale, which you've kind of mentioned all three of those.
Sure.
But let's just kind of deconstruct those three. Let's start with the family succession, then we'll go into the management buyout, and then third-party sale. What are the ways that we can finance those deals? What are the ways, in the case, especially the third-party sale, what are the metrics you want to focus on as a business owner to make sure you're maximizing that value at the end of the transaction? Because those are all different, right?
Sure.
So let's start with the first one, family succession. How can we potentially finance that? How do you break it down? And I understand that's a loaded question, right? If there's numerous kids in the family, what have you. but just the basic construct. And then we'll dive into the management buyout and, of course, third-party sale.
Sure. So Tyler's going to buy in to our lounge. We're going to assume I need some capital out of this transaction. It's not a gift. So for that financing, if Tyler has the ability to obtain financing on his own, clearly that's a great way to do it.
Sure.
But often when we are talking about family and next gen or, G3, G2, G3 buying into it, they don't. So it could be that we finance that and he pays that over time. It could be that as a parent, I co-sign with him, in the ability to recapture the business in the event there's a default or things aren't going well. And obviously that is a very important nuance that needs to be part of that transaction.
Now let's go into the management buyout concept.
So management buyout, that is really where we want to make sure that the management team is capable. The management team wants to do it, because often we think, hey, they want to do it. Our cigar lounge, I assume you're young enough, you still want it, even though I'm ready to get out. We get to that point and no, you're not interested in it. Well, that's a whole different situation. So that's where that time frame of starting early, having conversations early, ensuring that they're part of the decision process and they have that owner's mentality for a period of time. Then it's a matter of, all right, how do we ensure that they obtain financing and have the ability to buy it out? It could be over time. We start to, Tony, you're my partner, you're my key guy, but you have no equity. I begin to grant you some shares in lieu of some raises, things of that nature to move a little bit of equity to you. But at the end of the day, if it's a valuable company, there needs to be a true financing process.
Now, third-party sale. This is a two-part question. The first part is what are buyers looking for, right? Obviously, there's the general, franchise value, things like that. But what are the metrics that we should be focused on when selling that business to a third party? And then the second half of that is what are some of the pitfalls or things you want to avoid, especially during contracting? I'm thinking about earn-out periods, things like that.
Sure.
That they should, just keep an eye on, because we've seen business transactions go sideways when a third party buys it and they have a variety of, riders, if you will, on the ultimate valuation of that business.
Right. So as you think about a third party buyer, I think, again, maybe the most important thing is time and foresight in beginning to address this early. Is there someone in our industry that it makes sense for this to be an acquisition for them? Is someone rolling up cigar lounges? Does that make sense? Then for a lot of businesses, is it private equity? Is it a family office? So you've got to really outline and figure out who some of those buyers are and what's important. And then you put yourself in their shoes. What's important to that buyer? Why are they acquiring us? And how can we ensure that this is successful for both sides? Certainly, earnouts are really important. And so understanding what that earnout looks like, what that time frame looks like, what the commitment ask will be of us, the two of us are selling out. How many years do they want us hanging around? How much upside do the two of us have? We've agreed to sell it for $10 million. How much upside do we have? How much downside do we have? And how much control staying behind do we have in that? And so the nuances of that are absolutely critical. And that's where you really want to ensure that you're talking to someone who does M&A work on a regular basis and understands all the aspects of this, and perhaps even someone that specializes within your industry. I have a good friend in town that has an M&A firm, and they focus very closely Southeast and on industry, like industrial businesses. If that's the kind of what I have, that's who I want. I don't want to go to someone who maybe is a generalist and takes anything. And then lastly, during that process, when they're trying to sell our business, do you want the process where they send a packet out to everybody? Mm-hmm. Everybody and their uncle knows we're for sale. If we haven't communicated, getting back to your messaging, if we haven't communicated with our team, our staff, trust me, once that process occurs, everyone knows. So transparency to the team is critical. And then to obtain the highest offer and not just throw it out to everyone is a very selective process of targeting someone in the industry, targeting those acquirers that make sense. Often you achieve much higher multiples that way.
Yeah, I think there's some really prescient points in there, one of which being, you mentioned early on, if it's a roll-up, so another competitor in the industry, or maybe a larger national firm that wants to be in this market versus PE, it's when you're consulted with an M&A, a broker, if you will, I always found that it's very important where if you want to lean into the PE world and focus on that, the packages are different. The targets are different, right? You want to lean into top line gross revenue and the margins and where they can find value or where they can create value.
Sure.
Whereas if you're going to a roll-up, it's all about market share and franchise value, and you lean into that. So it's almost as if when you work with a broker and you think about it intelligently, you want to almost fixate on a certain category, right? And if you do pray and spray like you suggested, there are damages to your market awareness, right? Clients, of course, employees. And then if you don't, and it's almost like once the cat's out of the bag and you don't get the valuation you want, it's hard to pull that back.
Oh, absolutely. You are dead in the water for a while.
Yeah.
So that's why preparation is critical.
I love that. So now let's shift gears a bit. We just have a few minutes left. I'd love to talk a bit about everyone's favorite word, taxes, right? So when we think about selling a business, just an ultimate monetization, right? A transaction. Right. What should we consider as it relates to taxes, especially with retirement on the horizon?
Well, that gets back to the type of sale we're going to do. Is it going to be stock? Is it going to be an asset sale? There are different tax implications behind this. And part of doing this properly is planning that out, doing pro formas with your CPA, with your advisor. Under this scenario, what does this look like? And for the two of us, okay, we're no longer going to have the revenue from our cigar lounge. What do we think we're going to sell the business for? In today's world, what does that look like for us in terms of income replacement? And sometimes it's fantastic. Other times it's a bad time. And you have single period, if you will, sale and reinvestment risk. We're picking a single point in time. Think about, we're selling a house, right? We're selling a house right before COVID, and it was $1 million. Couple months later, COVID occurs, housing prices shoot through the roof, and now it's 1.5. It's a 50% increase just in a couple months. Well, that knife cuts both ways. So, and that's where a staggered sale can be very attractive for people so that you can mitigate and really be mindful of the tax implications. You can be mindful of having different vintages of taking that capital and allocating it to provide that income and that asset for your family.
I love that. So final question. You've sold a business. You've taken the proceeds. Now what? Like, how do you, like what, again, I realize that you can't provide financial advice in this imaginary setting, but if you have all this money now and you have this retirement on the horizon, what's the best way to take that kind of that lump sum and maximize its value within your portfolio? I know that's loaded.
Yeah,
I know
that's a loaded question.
Right.
And it really depends. It's interesting because so many business owners, the vast majority of their assets are in their business. And so their balance sheet looked very different. And now all of a sudden, we have this large amount of capital. It's not qualified. So that's where having a financial plan and really doing a pro forma of what this looks like before we even sign on the dotted line. And even more importantly, most of the time, there's enough money. We have the ability to help clients allocate it properly and think about it and ensure that they have sufficient income and the growth of the asset for their families. But for a lot of us as business owners, it's a different mindset when we no longer have that. And while there's a financial side to this, there is a psychological side. What do I do with my time? I'm used to going into the cigar lounge, working. You and I are used to doing that. We no longer do that. That often is more of a struggle than the financial, than the transaction, because that's long lasting.
I love that. Because there is such a shift, right? You still need to have purpose. And also, I think the other big one is you go from taking a salary, a paycheck, right, as the owner,
Right,
to not having that,
yes.
right? So now you have this lump sum, and so you have to think through like, okay, I don't want to adjust my lifestyle. So how can I make that money work for me in retirement?
And another aspect, it's having done this for 30 years, it is so interesting to see business owners post-sale. We had a certain amount of your assets while you had a business, and they vacillated with the market like every investment does. And you were accustomed to seeing that. We now have $10 million, $100 million from the sale of your business, and it goes into an account. Almost always, your perspective of that $10 million is very different than the other portfolio you've had. Because your business, while it theoretically went up and down in value, you didn't see it. And that aspect is absolutely fascinating to watch because it happens for virtually every business.
That's interesting.
Yeah.
That really is interesting. Wow, what an incredible episode. One more quick question, though. What is, and I think I know the answer, but what is one piece of advice you'd give a business owner that is thinking about or not even thinking about the sale of their business? What's that one piece?
I think whether you're thinking about selling or you're not thinking about selling, you should go through the fire drill that you're not there. What happens if I don't show up, I'm not available to run the business? Can the business survive without me? If it can't, I haven't properly structured my business. And there's a lot of pride that they need me. You know, I show up and I'm needed. That's great. But this is an asset. And if I have to be part of that equation, the transaction value is going to be lower. And even if I don't want to sell, my business needs to be able to operate without me. So I think having a highly efficient, well-organized business, having all your processes written down so that literally someone can come in and plug and play.
I love that. That's great. Incredible. Wow. Don, thank you so much. This was actually a fun conversation. The idea of succession planning, selling your business, and all the valuable words of advice. I really appreciate it. One more thing, though, I have to say, you keep bringing up this cigar lounge thing. I don't know. Maybe we should take this show on the road at one of the cigar lounges.
That wouldn't be much of a stretch for the two of us.
It
So
wouldn't be.
I kind of like that idea.
It wouldn't be. Hope you enjoyed the show. If you'd like to hear more about Don or learn more about him, visit him on his
LinkedIn
page. I think you have a TikTok page too, where you do all sorts of dancing.
Actually, I don't.
Okay.
Tony. But maybe I'll consider that.
Otherwise, you can visit him, of course, at moranwealthmanagement.com. If you like the show, make sure you hit the like button, the subscribe button, but most importantly, share this with your family and friends, and of course, in this case, business owners. Until next time, I'm your host of Dime After Dime, Tony. Don, thanks again.
Thanks for having me.